will increase very dramatically to something like 35% minimum of total tax revenues in 10 years' time. My projections have them like at 50% of tax revenues in 10 years' time. At that stage, there's only one way out: massive monetization. And Mr. Bernanke, you can be sure, he will one day increase interest rates, but he'll keep them below zero in terms of real interest rates. In other words, you could have 5% Fed fund rate and inflation is 15%, so you still have negative real interest rates. So this projection of a zero value for the US dollar is very high. Now the problem is that the other currencies are not much better. I mean, don't ever think that this currency on which you're sitting or which you keep under your mattress is a much better currency. They're all going to go to the pots, and there's only one serious long-term currency, and that is you have to move your money into hard assets, either gold, platinum, silver, or palladium, or to own some real estate. Of course, the timing is always important, or equities. Because once paper money loses its function to be a unit of account, you have to move out of paper money. So I'm not saying that today you have to sell all your cash and buy equities, but over the next 10 years, one of the worst investments will be in cash in any currency. Thank you for your attention.
Thank you very much. So getting closer to some specific recommendations. And now, Professor Gilman, Martin, maybe you say something about the ruble as well.
First, a short and maybe a long-term comment, just to follow up on that forecast of the demise of the dollar. Just to make the point, though, that there is a timing issue here, and even if there seems to be unanimity that the dollar's days are numbered, I should just recall the story that at Davos World Economic Forum, exactly 5 years ago this week, there was a dinner meeting, and some of the world's foremost economists, people like Ken Rogoff and Stan Fisher, Mike Musa, were in the audience, and Chairman asked, what do you think is going to happen to the dollar this year? This is beginning of February 2005. And they all uniformly said the dollar, for all good fundamental reasons, is going to decline. What happened? The dollar rebounded. Okay, so just to say that there are a lot of factors at play, and these timing questions in the short term make it, I guess, hell for traders to decide what positions to take. The longer term point, and I suppose it's in line with what has been said by previous speakers, but a just slightly different slant, is that I would agree that the dollar in particular, its days are numbered, because I cannot imagine, and I say this as a former International Monetary Fund official, is that I cannot imagine an international monetary system where the major debtor countries of the world are dictating how the financial system will be run. One of the ironies of recent history is that within an unusually fast time frame, over the past 10 years, what were the major debtor countries of the world in East Asia and in Latin America and in Eastern Europe have become now the major creditor countries of the world. And it's inconceivable that countries like the United States and Britain can not only continue to control the decisions and boards of the International Monetary Fund and World Bank, but can actually dictate the kind of institutions and currency arrangements that will be in place. It is no longer in their gift to give. The arrangements in future, it will be messy, but I am sure that over the course of this decade, whether it will be smooth or not, or through the G20 or through the market more likely, it will be the new creditors of the world, the four R's as you were referring to them, that will, and others like the Saudis and the South Koreans, that will be dictating what they as creditors will require in order to continue lending to the borrowing countries. Now finally, I would just want to make the point on Russia that maybe unlike the United States, where the idea is to, if Marc Faber is correct, that the Fed would like to pursue a policy, if possible, of keeping interest rates in real terms negative, Russia, for the first time this decade, has moved recently into a world in which it actually has real positive interest rates. And this is, I think, going to transform the investment and business landscape in Russia of low inflation, high and meaningful positive real interest rates. It means that normal business can proceed making things and not just trying to do financial manipulations. I think it's a real opportunity for the Russian economy. However, how is this going to translate into exchange rates? I don't think it will. I think in terms of nominal exchange rates, the ruble will be more or less where it is now a year from now, because it's managed by the Central Bank of Russia, and they want to deliver exchange rate stability. Unless somehow the Chinese are persuaded to move off of their peg to the dollar, then maybe other things can happen here. But I think follow the Chinese. If the Chinese are keeping their currency pegged, I don't think the Russians are going to move. That being said, I guess there will be continuing real appreciation of the ruble.
Yeah. Thank you, Martin. And the last statement from Michael Wexler before we move to a second round.
Thank you. I'd like to make 2 points. One about the dollar as a reserve currency and why we talk about why panels exist to talk about whether it's still viable as a reserve currency. And second, I'll try to say something positive about the dollar because no one else has. First, the dollar as a reserve currency has become a very topical subject in the last 2 years, mostly because of a huge central bank accumulation of dollars. And they're all very concerned about this massive amount. They've come into the markets, intervened, and bought something like $5 trillion. It's generally seen as a sign of strength. These piles of dollars are often referred incorrectly as sovereign wealth funds or as treasure chests that these countries are sitting on. And it conjures up an image of strength and power for that central bank and by extension for that country. But I want you to bear in mind that when they go into the market and intervene and buy dollars, they have to give away something in exchange. They give away their local currency. So they're building up a liability on the other side, either a liability that they borrow from the market by issuing bills or bonds, or that they print. But either way, it's a liability that at some point has to be repaid. So in fact, what these central banks have done is built up a massive speculative foreign exchange position. Central Bank of China, along about $2 trillion, is probably the biggest speculative FX position in the history of the world. And they're stuck with it. And they've built up these positions countervailing against natural economic market forces for their currencies to strengthen, and they've resisted that. And it has consequences. One is that the benefit of it, which they know is greater exports and creation of jobs, the downside is that they're going to lose money on that position. So they've built up $2 trillion of reserves, and they're probably going to lose 20% on that at some point when they decide to let the currency strengthen. So they're going to lose maybe $400 billion. So they're concerned about that. And they're wondering, what do we do about it? Well, first, let's blame somebody else for the dollar not being strong. Let's point focus at the U.S. for having a trade deficit or a budget deficit, and complain against others if the dollar is not strong enough to let us out of the position at the right price. But I think really they should only be pointing the fingers at themselves, sort of hand up, we took an enormous FX position and we've been blown away on it to the tune of 20% of GDP, and we knew it was for the greater good, so we did it in the first place. But in any case, they have this long dollar position, and so they're asking questions like, is that the right position to have? Well, if they didn't think it was the right position, they shouldn't have taken the position in the first place. So they're looking for a backdoor way to get out of the dollar, to get out of this coming hundreds of billions loss that is imminent. And they say, well, what should we buy instead? Right? We want to get rid of these dollars and buy something else. What's another good reserve currency? Where should we move our money? And they really, unfortunately, have only one choice. And it's at that point that I'll come to something positive about the dollar. If you take a group of other currencies, Canada or Australia or New Zealand or Brazil or Norway that people point to, okay, commodity strength, these ones should be okay. They're extremely small currencies in the context of global GDP. And even gold is extremely small in the context of global GDP. So if China has $2 trillion of reserves and they want to diversify even just 40% of it, they need to buy $800 billion of something else. In all those currencies I just mentioned together, maybe they could buy 25 billion. So maybe they could put 3% into something else. So they're left saying, what can we buy in gigantic size? And there's probably two choices then, the yen or the euro, and maybe the pound, but the pound in let's say a quarter measure. So they really can only buy two, which is the yen or the euro, but the yen has a zero yield, has unnaturally low yield, tremendous structural problems and deficits, and it really wouldn't be very fair to go to the Bank of Japan and beggar thy neighbor and say, we have all these reserves, you have all these reserves, do you mind if we pass another 500 billion over to you and move the problem along? So their only choice, physically, their only choice in the market is to buy euros. And they and other central banks do it every single day. The euro is bought in billions and billions on ongoing order basis to every bank in the market every day. And that has created what I think is a bubble in the market, and that is the euro. So I'll say something positive in terms of the dollar by saying something negative against the euro. And they really only have one currency to come back to if they want to get out of the euro in hundreds and hundreds of billions, which is why I think the euro will depreciate soon against the dollar. The short dollar trade, as was pointed out by economists in 2005, it actually goes even further back to 2002. So this weak dollar story, twin deficits, blah, 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 is 7 years old now, coming on 8 years old. It really is an old story. And so at some point you have to say, at what point is that story in the price? And, it's common knowledge. Everybody knows it. It's being talked about at every panel, at every conference. Maybe that's already in the past, and we need to look forward and say, what's the right thing going forward instead of what are the common arguments? And on two fronts there, one in terms of why everybody hated the dollar or hates the dollar are its structural deficits. In terms of the budget deficit, that's now become a problem everywhere. Running a 10% budget deficit is kind of a common feature amongst many countries, so that doesn't single out the dollar as a negative anymore. And second, in terms of its trade deficit, as was pointed out, it's improving dramatically. And probably ex-oil, ex-China is going to hit something like zero this year. So the trade numbers are turning. The deficit is now a level playing field. So you sort of have to question your original reasons for hating the dollar over all this time. And even Marc Faber's comments, the dollar will be worth zero, he actually quantified later and said, as will all paper money. So if you're trading currencies from one to another, a currency exchange rate is a relative value expression. Saying both will go to zero doesn't really tell me which way that currency rate's going to go in the interim, especially on a 10-year horizon. And so my final thing is on the reasons that everybody bought the euro. The euro was bought for sheer physical access, for liquidity and depth and size. And at some point, all these central banks wake up and say, why did I buy that thing? I bought it because I had to, but what are the reasons for buying a currency? Well, I bought it for yield pickup. That's not the case anymore. It's negligible. I bought it for valuation. Well, actually, most people even buying the euro agree it's worth 110, 115, 120. Let's call it 115, so it's 20% overvalued. So you're not in it for yield. You're not in it for valuation. Oh, I'm in it because it's structurally extremely sound. Right? We've got problems in Greece, Italy, Spain, Portugal, Ireland, Austria, and on the periphery in the UK and Scandinavia as well. So we really have a structural mess in terms of what is called the euro and its periphery. So they come back and say, I'm not sure why I own this thing. The fundamentals compared to the US aren't there anymore. Valuation, yield, structural stability, there's really no reason to own the euro. And I think this Greece is just the final prick of the bubble to make them realize, wow, this whole why did I put 30% of my reserves of this massive FX dollar position that I built up that I know I'm going to lose money on? I put a bunch of it into euro to try to diversify, but that's just going to cost me even more. Thank you.
Thank you, Michael. And Michael was in a sort of privileged